We all know that feeling when you fail to hit your $1 billion nonprofit fundraising goal and only raise $130 million instead. But it's how you deal with that disappointment that defines you as an entrepreneur. Many people would take the easy route of just embezzling what they already had or asking their billionaire friends for more donations, but the team at OpenAI, well, they're just built different. At a time when the hottest for profit companies were losing money faster than nonprofits, the nonprofit OpenAI decided to become for profit, and within a few months, they were able to raise the $1 billion they needed. And in fairness, they did need it. Even back in 2017, long before anyone had heard of ChatGPT, the amount of computing power used by AI models was doubling every 3.4 months, so computing power was quickly eating up all of OpenAI's donations. Of course, the IRS doesn't actually allow nonprofits to simply convert themselves into for-profit companies, since that would allow fraudsters to trick people into donating money to a good cause one day, only to declare the next day that the money was actually to be used to build a new casino. OpenAI got around this by keeping the nonprofit company, called OpenAI Inc., in place and creating a new for-profit company, called OpenAI LP, as a subsidiary. OpenAI Inc. still owns the OpenAI trademark and has complete control over OpenAI LP, but OpenAI LP does all the work, generates all the revenue, and provides equity compensation to OpenAI employees and investors. The structure was actually a little bit more complicated, and between 2019 and 2023, it was rearranged a couple times, so that now it actually looks more like this. But the restructuring process left OpenAI's co-founder and largest donor, Elon Musk, to question the legitimacy of OpenAI's actions. So, is what OpenAI did legal? The simple answer is probably. There are no laws that ban nonprofit companies from owning for-profit companies. In fact, it's quite common for wealthy entrepreneurs to spend their careers building profitable companies and then donate their stock in those companies to one or more nonprofits. For example, Henry Ford created the nonprofit Ford Foundation and donated over 90% of the non-voting shares of Ford to the Ford Foundation. Eli Lilly, the founder of the pharmaceutical company Eli Lilly and Co., created a nonprofit called Lilly Endowment Inc. and donated almost $90 million, equivalent to over $1 billion in 2023 dollars, of Eli Lilly and Co. stock to the nonprofit. And Howard Hughes donated the entire Hughes Aircraft Company to the nonprofit Howard Hughes Medical Institute, effectively turning a large defense contractor into an untaxed charity. However, while there are no laws that outright ban nonprofit companies from owning for-profit companies, there are three major legal restrictions. Firstly, the for-profit subsidiary can create what the IRS calls unrelated business income, or UBI. UBI is income that a nonprofit generates from selling something unrelated to its core mission, and it's taxed at the corporate tax rate, even if the nonprofit is tax exempt in general. For example, if a nonprofit hospital opened a car dealership to help fund itself, then any income the car dealership generated would be considered unrelated business income, since car dealerships are unrelated to hospitals. That means all income from the car dealership would be taxed as if the nonprofit was a normal for-profit corporation. OpenAI really doesn't have to worry about this though, because both the nonprofit and its for-profit subsidiary are working exclusively on artificial intelligence. The second legal issue that a nonprofit can run into when it owns a for-profit subsidiary is a violation of fiscal responsibility, a legal duty to manage the money that they are endowed with in a financially responsible manner. 49 states have adopted the Uniform Prudent Management of Institutional Funds Act. I know, it's a mouthful. But MIFA typically requires that nonprofits diversify their investments in order to reduce risk, and owning a majority in a large for-profit subsidiary can often violate that requirement. However, UPMIFA only applies to nonprofit investments that are made primarily for financial return. If a nonprofit wants to make an investment primarily in order to further its mission rather than for financial return, then UPMIFA doesn't apply. That means when the nonprofit OpenAI Inc. created the for-profit OpenAI LP, OpenAI Inc. could have likely invested the vast majority of its money into the for-profit company without triggering UPMIFA, since both the for-profit company and the nonprofit company are working towards the same mission of creating safe AGI. Thirdly, the last big issue that a nonprofit can run into when it owns a for-profit company is called private enurement. Private enurement is a legal term for a concept that everyone understands intuitively, and it's what makes most people feel like it's unethical for a nonprofit to become a for-profit. Essentially, private enurement is when a nonprofit board member or employee is able to gain unearned benefits from a nonprofit by abusing their position of power at the expense of the nonprofit's mission. For example, If a board member of a nonprofit youth athletics club owned the facility used by that club and rented the facility to the club at a rate far above market value, that would be private enurement. If a nonprofit art gallery allowed board members to exhibit their art for free but charged other artists a fee, that would also be private enurement. In OpenAI's situation, there are all sorts of things that could be private enurement. At a basic level, using non-public research funded by a nonprofit to then create a for-profit company, which is majority owned by the nonprofit, but also partly owned by the employees of the nonprofit, is arguably an unfair benefit to those employees. It's a somewhat gray area of law, though, because while many nonprofits have been gifted majority shares of large companies, relatively few nonprofits have used their own money to fund new subsidiary startups, which employ some of the nonprofit's own employees. OpenAI's lawyers did their research, though, because they basically have gone as close as they can to the legal line without overtly crossing it. For instance, there was a legal case in 1980 where the IRS challenged a nonprofit church, which was compensating its minister through a revenue-sharing arrangement. Ultimately, the IRS ruled that since the arrangement provided potentially uncapped compensation, it was unreasonable and therefore constituted private enurement to the minister. OpenAI apparently took note of that case because when it created its for-profit subsidiary, it capped the potential return to 100 times the initial investment amount. In an OpenAI blog article at the time, they wrote, quote, "We want to increase our ability to raise capital while still serving our mission to ensure that artificial general intelligence, or AGI, benefits all of humanity, primarily by attempting to build safe AGI and share the benefits with the world. No pre-existing legal structure we know of strikes the right balance. Our solution is to create OpenAI LP as a hybrid of a for-profit and non-profit, which we are calling a capped profit company." OpenAI's employees did such a fantastic job with PR here that it would almost make you think that the capped profit structure was motivated by an innovative mixture of altruism and practicality, rather than the legal boundary of a 1980 tax court case. But is a 100x return on your money really that different from an unlimited revenue share anyway? Only the tax court can say for sure. If OpenAI is ever taken to court by the IRS, though, one thing that will actually help their case is the fact that Sam Altman was fired. That's because Sam Altman getting fired proves that no single employee had that much control at OpenAI. In fact, before the non-profit OpenAI created the for-profit OpenAI, it set in place certain checks and balances. Only a minority of board members of the OpenAI nonprofit are allowed to own equity in the for-profit OpenAI company. Furthermore, only board members who don't own equity can vote on decisions where the interests of shareholders might conflict with OpenAI nonprofit's mission. And that is exactly what happened when Sam got ousted last week. A majority of non-equity owning board members were concerned that Sam was shipping ChatGPT upgrades faster than was safe, so they voted him out.